Japan's bond market isn't just shaking. It is exposing the hidden fracture lines of the entire global financial system. Japan's rising bond yields signal stress in a system built on decades of artificial stability and aggressive central bank control. When yields rise this fast, it means investors no longer trust promises made by monetary authorities anymore. Japan is not a small player. It is one of the deepest liquidity providers in global finance. Any instability in Japanese debt instantly transmits shockwaves across global capital markets worldwide. Bond prices falling reveal how fragile leveraged institutions truly are beneath the surface. Years of zero interest rate policy distorted risk perception across sovereign debt markets globally. Investors were trained to believe bonds were safe regardless of fiscal reality. Japan's massive debt burden becomes unmanageable once borrowing costs normalize. The global carry trade depends heavily on cheap yen funding staying cheap forever. Rising Japanese yields threaten to unwind trillions in leveraged carry positions. As the carry trade reverses, liquidity drains rapidly from global markets. Forced deleveraging begins when margin calls replace confidence. Japan may be forced to sell foreign assets to defend its domestic system. U.S. Treasuries become collateral damage in Japan's fight for stability. Selling pressure on Treasuries pushes American yields sharply higher. Higher yields increase debt servicing costs for governments already drowning in liabilities. This exposes the unsustainable nature of modern sovereign finance models. Central banks lose narrative control when markets stop listening to guidance. Years of monetary easing delayed pain, but multiplied systemic risk underneath. Now markets are repricing risk violently instead of gradually. Paper assets depend entirely on trust in institutions and policy discipline. That trust is eroding across bond markets worldwide. Investors begin questioning the real value of fiat-denominated promises. When confidence fades, capital searches for assets with intrinsic scarcity. Hard assets regain relevance during periods of monetary disorder. Silver stands at the intersection of money, industry, and scarcity. Unlike bonds, silver carries no counterparty risk. Physical silver cannot default, restructure, or be diluted by policy. Supply constraints amplify silver's response to financial stress. Paper silver markets struggle to reflect real-world shortages. This disconnect exposes structural weakness in commodity pricing systems. Volatility in silver reflects fear, not speculation alone. Rising silver prices signal declining confidence in sovereign debt. Investors increasingly demand delivery instead of paper exposure. Physical demand tightens as distrust spreads across financial markets. Monetary debasement fuels long-term demand for tangible stores of value. Inflation is not temporary when debt must be inflated away. Governments rely on currency erosion to manage unpayable obligations. Savers pay the price through declining purchasing power. Bonds fail as inflation hedges when yields lag real inflation. This forces a reevaluation of so-called risk-free assets. Deleveraging is painful because leverage hid structural weakness. Financial systems built on debt crack when refinancing breaks. Japan's bond market is flashing a global warning signal. Liquidity crises never stay local in interconnected markets. Contagion spreads through balance sheets, not headlines. Central banks are trapped between inflation and insolvency. There is no painless exit from decades of excess. Market discipline returns when intervention credibility disappears. Asset prices reset to reflect real economic constraints. Debt loses value when confidence evaporates. Tangible assets gain relevance during systemic transitions. Silver reflects monetary stress faster than most assets. Its small market size magnifies price movements during crises. Volatility is the cost of honest price discovery. Stability was artificial, maintained by constant intervention. Now markets must absorb reality without protection. Japan's crisis forces investors to rethink global assumptions. U.S. dominance does not immunize treasuries from global stress. Debt interconnectedness ensures shared consequences. Liquidity dries up when everyone runs for the exit. Safe havens change when systems lose credibility. Silver benefits from distrust, not optimism. Physical ownership becomes more important than digital exposure. Financial repression pushes capital outside traditional instruments. Monetary history shows hard assets survive policy failure. Bonds depend on future taxpayers' willingness to pay. Silver depends only on physical scarcity and demand. Systemic risk rises when leverage exceeds growth. Japan's aging population worsens its debt math. Demographics amplify fiscal fragility. Printing money cannot fix structural insolvency. It only delays recognition of failure. Markets eventually force adjustment through price. That adjustment is rarely orderly. Silver reacts early because it prices distrust quickly. Bond markets react late but violently. The transition phase is the most dangerous. Investors must understand cycles, not narratives. Financial repression always ends the same way. Debt bubbles deflate through inflation or default. Japan faces both simultaneously. Global investors are waking up to this reality. Asset allocation shifts reflect survival, not speculation. Hard assets hedge against systemic miscalculation. Silver's role is protection, not prediction. Monetary trust, once broken, is hard to restore. Central banks cannot command belief indefinitely. Yield spikes are symptoms, not causes. The disease is excessive debt. Japan is simply the first visible fracture. Others will follow as liquidity tightens. The global system is entering forced deleveraging. Wealth preservation replaces yield chasing. Tangible assets anchor value during chaos. Silver reflects the cost of decades of denial. The shift marks the end of cheap money illusions. The new era rewards realism, discipline, and scarcity. Disclaimer: this content is for educational and informational purposes only and should not be considered financial, legal, or investment advice.